So now as we start segment 2, you're not seeing double. We're just going to use the 2 charts that we ended with because it's important to kind of build that back up into where we sit for today, given where things are going on the inflation side, economic drivers. So here you can see that the U.S. Economic Suprise Index, rolled over again. It's still positive. It's still over 0, but you're starting to see, again, the people were getting excited, taking estimates back up, and we're coming in light again. And it's a mixture of 2 different things because PMI is also in this, and PMI came in negative, well below estimates. But some of the reasons it missed was supply chains getting better, which isn't really a negative. So it's a matter of weighing it, but you're starting to see, again, starting off slow, a little sluggish, and that's going to bring us, I think, back down as inflation coming right in line, slightly above, is going to give way to something a bit slower. So then when you look at how Congress and the fiscal benefits and how they continue to expire, so you have the child tax credit, the infrastructure side, some of these key safety nets are now officially gone. It doesn't look like they're going to get kicked to the right, extended for any meaningful time. And this is that fiscal drag we've talked about. We've seen savings rates back to 2019 levels. You're seeing a slowdown in retail sales. You're seeing that pressure on real wages, which again is going to bite into what does GDP look like, creating that fiscal drag we've been highlighting, which is then going to be layered on top of that. Some monetary tightening with quantitative tightening as we get the QE reductions and then rates starting to go back up. So when you start taking this all together, we have to really look at, well, what happened with CPI? Where did CPI come in? And what does it mean for really the future? Because when you look at what happened in December. So one of the things that we were talking about in December was that there was a chance we could start to see the rate of change slow. And it did. The expectations were for 0.4. It came in at 0.5. And you can see it's off that elevated level. And we think that the pace continues to flatten out. And just given where crude prices are right now, where gasoline prices are, and where sticky inflation is versus flexible, we thought there was a chance that you could be below 0 in January and February. So far, based on how the beginning of January has gone, very unlikely we're going to be below 0. It's more likely we'll be at about 0.2, 0.3% increase. And then February, depending on how things play out, could be that slowdown in general. So you're still going to see the pace of it slowing, but it's still adding on to where things are and creating that stress, which is why when you look at the year over year, so CPI ex food and energy is expected at 0.5, came in at 0.6. Again, the key stickiness side, which is where we continue to hone in on, because that's the meat of the pain that we talk about when we look at real wages, when we look at spending capacity that the consumer really has. So then when we look at year over year, was expected at 7%, came in at 7%. Ex food and energy was expected at 5.4, came in at 5.5%. So that is a huge problem when you look at what is happening right now, because and the rent continues to be missed. And this is where, when we look at sticky, this is the key piece. So the OER, which is the owner's equivalent rent, was 3.8%. And rent of primary residence was higher by 3.3%. But when you look at all of the real-time data, Apartment List said this week that 2021 rents were up 17.8%. So if you take the 17.8% and put that into the calculation, CPI is over 10%. Now, the way that this is going to be calculated is they're not going to put the rent in all at once. Instead, it's going to come in pieces, which is why I've been talking about this as really putting a floor in where inflation is and creating that stagflation depending on the movement of flexible inflation, i.e. energy, food. So those are some of the key pieces. The other underlying problem of the 250 plus CPI components, 83.8% of them are growing more than the 2% target. And the issue is, which is why the Fed is now starting to panic a bit, and panic is probably the wrong word, but look at this tightening, is because a lot of those subcomponents fall under the sticky category. And those are things that are not going away anytime soon, and also impact the most the living wages that we've been talking about, which is why we have talked consistently about U.S. real wage growth. So U.S. real wage growth, weekly earnings year over year came in at negative 2.3%. Then when you look at hourly earnings year over year, came in at negative 2.4%. So when you look at where things are right now, you're just seeing the underlying stress, because even though the people wages are going up, it is not anywhere near enough to keep pace. Now, this will start to adjust as inflation kind of flatlines, but and then the question is going to be, well, when do wages respond? So as you see the supply chain getting a bit better, companies have a bit more flexibility to increase wages, and as inflation kind of gets that stagflation look, then you're going to see wages start to cross over, but it's not going to be enough to really stimulate the economy, to really drive the consumer, which makes up over 70% of GDP, which is why we keep talking about this really heavy recovery. Because there's some estimates that the recovery is going to be better than after 07, 08. And I just look at some of these data points. It's like, but why? Are we looking at just comps where comps are easy? Well, in 2021, comps aren't as easy as they were in 2020, and things start to get a bit more difficult. Margins start to come under pressure because even though you're starting to see prices level off, they're not coming down. And when you look at the deviation between prices paid and prices received, well, there's still a gap. So you're still going to try to get as much recovered as possible, but it's going to be difficult as we're starting to see the consumer balk, and this is one of the key reasons why. Now, looking at inflation eating into the wages in the U.S., this gives you that idea of what negative real wage growth is and how this continues to be a stress, where even if you get a bounce, is it sustainable? And then if crude prices continue to go up, well, flexible inflation is going to continue to be elevated, which is even if you get wage increases, are wage increases enough to offset that? And these are these convoluted things that we continue to try to hone in on. Now, when you look at Johnson Redbook Index same-store sales weekly, you can see that we're still elevated, coming back to the low end. Retail sales per Johnson Redbook still strong year over year, but trend has stalled. Sales were up 14.4% in early January, lowest rate since July of 2021, and that's something that we think is going to continue through January and into February. Now, when we look at the contribution of CPI, so in December, energy prices had moderated a touch, so that is obviously going to reverse back up. But all other components, and this is what we've been highlighting for I don't know, depending on how long you've been listening to us, we've been talking about this. The all other CPI components is the biggest piece that is what is starting to get that panic, because the view was, as you go into April, was that this was going to peak and then they were going to fail. But it's not. Instead, it's actually gaining momentum, where used cars, rental, insurance, lodging, airfares, again, flexible. That can ebb and flow, but you're not seeing it in the all other index. But then now when you turn to rates, so the 10-year term premium is too low versus the 2 to 5 cash curve, because when you look at where historically we sit, given the trend line on where the 10-year term premium is and where the curve is, we should be at least 100 to 150 basis points higher. As the Fed backs out and stops buying at the level they're buying, you're going to lose your largest purchaser. So that's going to put more volume into the market that has to be made up by others. Now, there's also the convoluted side of, well, we have to look at inflation, because if you look at inflation, rates should go up. But if you look at growth, and if growth is going to be negative, rates should go down. So this is where you're going to get this kind of battle of who is going to win, inflation or growth. But I think it's tough right now still because you're not getting a clear picture until the Fed really starts to accelerate their tightening, or at least not buying as much, to see where the market really shakes out. And that's where we think rates are going to shift up, especially with now the probability of 4 rate hikes coming in at 90%. And remember, I was laughed at when I said that there would be 3 to 4 rate hikes February of 2021. I said that it would happen in 2022. People told me I was crazy. Well, here we are. So this is something where I think we're starting to, it's becoming market accepted. And remember, the Fed won't do anything that the market doesn't expect. The last thing they want is to spook the market, because anytime the market gyrates because somebody said something, they completely backtrack, or they say something to counter it. So again, this is why if Fed rate hikes are expected, I think the Fed will do them. It will be a quarter point. They won't, God forbid, they do 50 basis points. But that's where the first 3 will likely happen in a quick succession, and then they'll wait to let the market digest it before they do another. And then when you look at the Fed balance sheet, this is why. Well, the Fed balance sheet has never really gotten anywhere close to where it should. And when you look at back in 06 and 07, and I think everybody had this call right, was once this starts, it never stops. And Bernanke was like, no, that's not true. We're going to reverse. Don't worry. Well, it's now how many years later, and it has not only just not gone down and stayed sideways, it is exploded to the upside. And this is where I think that underlying pressure of what does the future hold comes into question. And that's when you start looking at the 10-year break-even inflation rate and where things are, where on the inflation-protected securities, you're seeing that come back up, rolling over a bit, but that's going to put pressure on the generic 10-year. And this is when you look at the inflation rate and where things need to sit, it has to be, based on where it is, just over 2.5%. And I think that's going to act as essentially a magnet to really pull this much closer to the 2% mark that we've been highlighting. And then when you look at the U.S. break-even and how it continues to climb into year-end, well, as inflation starts to kind of flatline a bit, I think you're going to get a little bit of a makeup, and you're going to see these continue to drift higher as the Fed backs out and isn't buying to the same percentages they have been. Now, when we look at this and take this into perspective on the ISM side, so the December ISM Services down to 62 versus the 67 estimate and 69.1 in the prior month. Business activity, new orders, backlogs, and supplier deliveries all fell, but are still expanding. Employment fell slightly. New export orders rose to 61.5 versus 57.9. Again, all of these are important. So when we were talking about what is driving some of this, economic surprise index, that decline, it's the service PMI. So the fact that this is coming down, I think, is also very important because it's coming down for good reasons. Supplier deliveries are speeding up, but new orders are slowing, backlogs are slowing, but business activity, but it's still expanding. The whole thing is, in our view, it's going to expand at a slower pace, again, bringing down some of these underlying estimates. And then when you look at the contribution to headline ISM services, this is when you're starting to see that supplier delivery really drawing that down and providing that negative move, but based on how elevated it was, it's really not negative. It's actually showing that some things are loosening up, and the supply chain is starting to catch up with itself a bit. Now, getting a bit more specific, inventory sentiment gotten a bit better, but still very tight, which is why we're seeing some of this, looking to purchase, looking to try to maintain a certain amount of inventory going into the new year. And then when you look at prices paid, they're not going up, but they're not going down, they're going sideways. And prices paid is the one that is the leading indicator of, well, where are prices going to go over the next few months? So then when you look at input prices are back to the highs and trending up. And that's when you look at all input prices in consideration of wages, which is why when you look at ISM Services price versus core PCE, the trend continues to pull it higher. And now rounding that all out of small business Optimism, What is the optimism? Well, it was expected at 98.7, came in at 98.9. So kind of right in line, but what are their expectations? Well, Optimism index, inflation is the single most important problem, and it's the highest it's been since 1983. So this is a real issue on how are they going to manage this given where wages have to go to attract employees and where can they sell their goods and try to cover their overhead. Small business optimism, the cost of labor, single most important problem, also shifted higher because how are they going to pay these individuals given inflation? Now, higher prices dipped down, but still elevated. We're not talking about this huge reversal, but a slow dip and just stalling. And then the price plans for the next 3 months are looking at to be fairly stable. And this is what we said last year rather. We expected to go sideways and just, slight little bit up, little bit down, and just continue to go sideways. And that's giving way to more of that stagflation look. So then when you look at the inventory satisfaction, it's getting a bit better, means that inventories are building a bit. We've seen inventories recover a bit, but it's really recovering in the sense where retail sales are slowing, supply chains catching up. So it's a mixture of both that's providing some of this underlying uplift. And then when you look at high wage jobs back above pre-COVID peaks, job recovery by wage tier, you're starting to see some of this come back, but it's still not enough to cover wages. And that eats into, well, where is inflation? Where is some of the discretionary income that's going to provide some of the uplift that I think is needed to see some of this economic expansion and this underlying economic growth? So then when we look at, well, is it transitory or is it starting or is it, where? So in low paid sectors, wage growth has taken off in the last 12 months. But how much can that continue? And if it starts to slow, because now you're starting to see, the retail sales, slowing down a bit, the ability to push through additional price increases starting to peter out. Well, I can't really continue to increase those wages, but I kind of have to because there's a lot of pressure and living wages and real wages. So this is where we start to see some of this unknown as to what happens on the retail front, what are some of the pressure points, and these are the things to watch, I think, as we go through the next few months. And then that's when you start looking at some of the underlying key pieces where used car prices are back on a rise as per Manheim, an increase of 47% year over year. Meanwhile, auto sales remain deeply negative at negative 24%. So U.S. auto sales are down, but yet used vehicle value index is up, and that's where we continue to see the constraint where when you look at the University of Michigan consumer sentiment, a lot of pressure because everyone's looking at this saying, well, I'm going to wait because I can't afford this. So that's where, again, the consumer balking, you should start to see some of these prices play out, but this is also going to lead to additional elevated inflation in January because this is part of the flexible piece that remains elevated that's going to draw that higher and continue to drive up and pull up the sticky front, again creating some of this stagflationary backdrop as we progress through 2022.